Welcome to the InterMarket Analysis video update. This is being prepared after the close on Friday, May 20th, to see how things look as of May 23rd, 2022. What I'll do is just go through some of the different charts, those that look at individual sectors outside of the S&P, as well as individual indexes, and then I'll also do some ratio studies to see how things are performing when compared to other assets. First, we look at S&P 500 valuation. This just takes the trailing 12 months, which is looking backwards. These are the earnings reports that were officially submitted under law, and we get those results, and then we can plot them all together on a chart. And this takes a look at all of these companies that make up the S&P 500 and treats them as a whole. This is different than how the stock market uses earnings because they tend to look forward. So there's a trailing 12 months, which is looking backwards, but there's also a forward PE or price per earnings ratio, which naturally looks forward. And that's based on forecast, assumptions, hope, projected trends that are happening within the company, and they can be modified over time. So what we get looking back is more absolute, where what we have looking forward is more just forecast and open to a lot of changes. But looking at this chart, we see that the S&P, which is the black line, it's come all the way down to actually fall below the PE 20 level. Now, historically, how this works is any PE ratio of 20 or above is considered expensive, and a lot of value investors, they'll stay away from stocks like that. If a stock or an index has a PE of 15, that's just about right. It's not too expensive and not too inexpensive. Then if we look at the PE 10 ratio stocks, those are considered inexpensive or cheap. And typically what will happen is value investors like to invest in those with the idea that they hang on to them until they get up to the PE 20 ratio level or so. Now, sometimes it can go beyond that, but that's the general idea of what some investors do. What we do is we measure the S&P against these different levels. And because the red level is where we're at right now, and we've been way above that for a long time, which means the market has been very expensive overall. Now, as we've seen the declines throughout 2022, this line has been coming down, and in an ideal situation, the red line should be going up because that means earnings are advancing and eventually they come back in line with each other. We've actually fallen below the red line currently. And then down below, this is just a measure of the difference between the two, how far away we were and then where we're at right now. And this goes all the way back to 1990. So we get a pretty good historical look. Now, if the market was to come down to a PE ratio of 15, it would probably have to fall below 3,000. Now, when the market comes down, we're actually below 4,000 on the S&P for it to be considered expensive, where if it comes down to the blue line, that's under 3,000. And if we come all the way down to the green line, which is considered inexpensive or cheap, we would have to fall down to about 2,000. So that's a huge drop from where we're at right now. But this is something that needs to happen periodically because you can be overvalued, undervalued, or fairly valued for a pretty long period of time. If you watch the financial channels and people come on and say this stock is cheap or this index is cheap or it's expensive or it's just about right, this is usually what they're talking about. Another way to look at this is taking all three of those lines, the PE of 20, 15, and 10, and then looking and seeing what happened historically. And I've gone through this in other charts where I have the 87 crash highlighted, the dot-com boom, bust, and recovery, the housing crisis. I didn't really highlight the COVID plunge because it happened so quickly, but you can see how earnings went down and then they've really shot back up. And we're currently at this level over on the top right-hand side. So the first area we'll look at is growth and value. The growth stocks are the kinds of stocks when people really look to buy low and sell high. If you're looking at dividends or companies that have been around a long time, or they sell products that people still have to have, no matter what's going on in the economy, that is considered more of a value company. And we have a peer growth index, which had been doing quite well. This chart only goes back about a year. And we were coming up in 2021. We topped out in November, and we've been declining ever since. And this red line is a 200-day moving average, and the blue line is a 50-period moving average. We had a death cross back in February, and we've been below these moving averages for quite some time. So it's just showing how growth is not doing so well. The next chart shows value. And yeah, it's been having trouble too, but not as much. And this is more of a defensive play where people will get into these stocks when they think we're hitting trouble. Then what we do is on the top, this is growth versus value. This is taking a ratio of the growth stocks against the value stocks. And they had been doing quite well, but from 2022 up to the current day, they've been really underperforming. Just the opposite is true when we look at the bottom. Value had been having a really difficult time as the market was going higher. As the market goes lower, the value stocks have been outperforming the growth stocks. We also have a peer growth index, and we measure that against a peer value index, which looks similar to this, and this goes back a little bit further. I just have the moving averages on here to give you a basic idea of the trend. When the red line is below, that's the 200-day moving average. That's the longer term trend. And then the 50 period, that moves faster because it calculates quicker. And when these are going up, the blue line will be above the red line. When we're starting to run into trouble, the blue line drops below the red line, and then both are declining. And this just shows another comparison between growth and value. Then we're also looking at value and growth. I know this is the same thing, but just in reverse. Sometimes we can see things that we can't see by just looking at one chart. This just gives us a little different perspective. Sometimes you might pick up something, it's like, oh, I didn't see that. Other times it's like, why are we looking at an inverse version of this chart? It's not telling me anything I don't already know. And that's up to each individual person. We also have a growth ETF that you can get into, and that's compared to the S&P ETF, which is the SPY. And the SPY had really been doing well, ran into some trouble in 2021, were able to bounce out of that, but has really been declining as we move through 2022. Then we have the value versus the growth. Again, just an inverse, how over a longer period of time, value had been really underperforming and was in downtrends most of the time. Well, lately in 2022, it is outperforming growth. We also have the growth index versus the value index. And again, a lot of these measure the same thing, but they use a little different methodology. And that's why I look at a lot of these, where I have the 50 and the 200-day simple moving average. And these red dots are just where they crossed. I'm trying to add some annotations to the charts to make them more helpful. But it just shows where growth is really underperforming value, just like we've seen in the other charts. Some of the index ratios, first we look at the CRB index in and of itself. This is a commodity index. Over here on the left, it just shows you the different percentages that make up that index. And a lot of these things, if you read through them, when they're going up, that means we're having more inflation. Well, the CRB has really been declining for quite some time with periods of uptrends. But ever since the COVID plunge, and after all the stimulus money and monetary policy and everything was thrown into the U.S. economy, we've seen the CRB index really going up, and this eventually bleeds over into the things that we buy, and that's why we're having to pay more for things. Here's the CRB ratio against the S&P 500, where for a long time, stocks were outperforming commodities. Well, it started to improve back in 2021 and then has really taken off in 2022. Just an inverse is showing the S&P as it was going up over a long period of time, started to flatten to decline, especially in 2021, and then has really been underperforming in 2022. Here's the NASDAQ 100, the 100 biggest stocks on the NASDAQ compared to the S&P. The 100 stocks on the NASDAQ, that's where your real growth comes from. That's the big boys. Those are the Apples and the Microsofts and the Googles and companies like that. And these are the companies that investors love to get into They're usually very liquid, lots of volume, lots of options, lots of different strategies that you can try. Well, lately, what's been happening is the NASDAQ 100 has been underperforming the S&P itself. Even though the S&P has been having trouble, the NASDAQ 100 has been having even more trouble. Looking at some other markets, here's gold, which is very important to a lot of investors. We look at the gold and how is it performing against the S&P 500. It's been just kind of bouncing around for quite a while now with spurts of upward trends. It really declined after the COVID plunge throughout the latter part of 2020 down through 2021. Well, when we really started to have trouble in the stock market, gold really started to outperform the S&P 500. Looking at some other stocks, here's the S&P 100. These are the 100 biggest stocks on the S&P against the rest of the S&P, and it also has been underperforming, although it has ticked up slightly. What a lot of investors do is they'll get into low volatility stocks during difficult times. This is an ETF of low volatility stocks, and it's been doing quite well with the rest of the market, but underperforming. We also had the big fall during the COVID plunge where everything fell, but lately, the low volatility ETF has been doing pretty well. Now, looking at a ratio where we compare the S&P low volatility stocks with the SPY, yeah, you would have underperformed for quite a while here, but throughout 2022, the low volatility stocks are outperforming. Now, it doesn't mean they're going up. It just means they're going down less. So this can be a bit misleading to say, oh, low volatility stocks are going up. Well, they may not be going up. They're just going down less. Looking at bonds and stocks, this just measures the S&P 500 against the 10-year Treasury yield. As you're probably aware, interest rates have been going up. Earlier, we saw the S&P outperforming interest rates. As we work our way through 2022, the S&P has been really underperforming the rise in interest rates. We also want to look at the Dow Jones Corporate Bond Index. The Treasury bonds are not the only bonds you can get. There are also corporate bonds, and a lot of folks like to get into those to diversify, or sometimes you can get a better return. Well, bonds at the Treasury level as well as at the corporate level have really been underperforming. This isn't a ratio. This is the Dow Jones Corporate Bond Index, and it just shows how we've been in a decline overall, but we've been seeing some recent bouncing lately, and we're also seeing that in the Treasury market. Junk bonds are another thing that people often seek because they give you a better rate of return, but at an increased level of risk. They tend to follow what the stock market does. They had been performing well. Well, in 2022, they are really seeing a decline, and this is based on price. Then what we do is we can look at the S&P on the top, and we can compare that with a junk bond ETF to a bond ETF ratio, and it just shows that even though junk bonds have been having trouble, they've been doing better than bonds. So they've been outperforming. Looking at some of the sectors, energy has been the number one sector to be in 2022. It wasn't always that way. It was really underperforming from 2010 up until the beginning of 2022, and really it kind of started before 2022 after the COVID plunge, but energy has been really outperforming. Then we have the energy sector against the tech sector. Looking back a little bit, energy was really underperforming. Tech was the place to be. Well, in 2022, tech is not necessarily the place to be, and the energy sector is the place to be, and that's where you get some real growth. Then here's just the tech sector all by itself. This is the ETF for the technology sector, and it had been in a nice solid uptrend, but has fallen below the moving average, and the red moving average is also starting to decline. This is the tech sector against the S&P. So it just shows that for the most part, the tech stocks really did well, but in 2022, they've been underperforming the rest of the SPY, which means the S&P 500. Some other areas to look at, we have growth against bonds. Growth has been really struggling. Bonds have really been struggling. Growth has been struggling even more than bonds lately. Neither one of them would have been necessarily good investments, although we're starting to see some folks move into the bond market. Bond prices have fallen so far. They're so oversold. There's really no safe place right now in the market. and people tend to flock to bonds when they don't know what else to do. Here's the 10-year Treasury yield. This is an interest rate compared to tech. As we were seeing the 10-year underperforming the tech sector, well, through 2021, it tried to outperform, then underperformed. Well, for 2022, interest rates have been going up a lot faster than tech has. In fact, tech has been going down as interest rates are going up. Except recently, what we've been seeing, usually when interest rates are up, stocks are down, and vice versa. But over the last week or so, we've been seeing interest rates move in the same direction as stocks. This is just an inverse. This shows how tech had been doing quite well on a relative basis compared to interest rates, but going into 2022, tech has really underperformed. Then staples. Staples are the things that you have to have, no matter what's going on in the economy. Discretionary are the things that make life nice or interesting. Ever since late 2021, staples have been performing quite well. They've seen some drawdowns, but overall, staples have been performing much, much better. And then this is a discretionary staples ratio. This just compares how discretionary have really been underperforming, where staples have been outperforming. This chart just shows the intermarket analysis on a daily basis going back to the end of 2021. And it just shows how oil has been performing the best since the beginning of the year. Gold had been doing quite well, but has been tapering off lately. The dollar, which had been weaker, has been performing better lately. Where the black line is the S&P, it's down since the beginning of the year. And bonds, even though they're showing some recent bounce right here, they've been performing the worst. So what can we look at as of Monday, the 23rd of May, that is positive? And if you watch the daily videos, this is going to be the same thing that you've seen before, where those things that are positive are energy, commodities, gold, interest rates, which are going up, and staples. Even though staples have hit on hard times recently, they're still positive overall. When we look at the negative things, if you watch the daily videos, this is the same chart that I show, where all of these different indexes and composites and sectors, they are negative currently, which is a large part of the market. And that's why there's really no safe place to hide right now. They have an adage in the market that says there's always a bull market somewhere. Well, where is it right now? Some people are looking internationally. Some people have been actually getting into bond yield ETFs, which you can buy low and sell high and those kinds of ETFs. Other than that, there's really not a strong place right now. Some of the cryptocurrencies have really had trouble as of late, and that's what's really causing a lot of confusion right now. So thank you. I hope this was helpful to you. I'm not sure how often I'll do these intermarket analysis videos. Sometimes once a week. If things change, I'll go ahead and do a video at that time.